Rehman Arif, organization performance modeling expert, and also in operation excellence, assert efficiencies and governance, and his industry verticals are automotive, FMCG, and services. So I'll hand over to Mr. Abdul Rehman to take over the session. Thank you.
Hello everyone, good afternoon. This is Abdul Rehman Arif, and I'm the founder and CEO of MMBEC. And bundle of thanks, and hope everyone is fine in this critical situations, and it's pray for my heart that Allah. So my topic is about the shielding profit and loss and the cash. And before starting my topic, I want to make this session bit light. Very technical conversation has been done. So I will try things before moving forward to the detailings. So just so during my presentation, can we move to the next slide? Okay, so I start from the basics. So when the executives and the top management are busy, and they are deep in the most competitive and the basic concept, practically the business works, or the equity liabilities. So I keep on explaining the concept of this thing. So when the assets are being invested and they're converted, then basically the journey of profit and loss is started. And these assets are being used to create some sales, and sales, you subtract some cost of goods services sold and cost of services sold out of those sales, and then you earn some gross profit, and then you subtract the operating cost from the gross profit, and then you get the operational profits, and then you subtract the financial cost out of that, and then you basically get the profit before tax, or the EBIT. Then you subtract the tax, and you will reach to the profit after tax. And just move forward. You can see there's two things: the sales and the profits. This is called the profit and loss. And then this profit, where it will goes? It will again become the part of the equity. And equity is again converted into assets, and then and that assets will again basically utilize to generate some sales, and that sales is basically again running the similar cycle, and so on, and at the end you get again some profit, and this is an ongoing concern, and this is an infinite cycle. And the top management and the top executives in the organization, they are juggling between two things: balance sheet and profit and loss for the whole of their lives. And this juggling is basically called the business. You always trying to put up some balance between these two things. Sometimes one element got more weight, sometimes another element got more weight. But during the COVID scenario, I would like to emphasize your thoughts at certain point at the end of this slide. So this is an infinite cycle which is happening by and if we keep on clicking on this slide, we can see that the balance sheets is converted into the profit and loss, and profit and loss is converted into balance sheets, and balance sheets are again converted into profit and loss, and so goes again and again. It's an infinite loop. Okay, but the very important thing, and where the cash is happening in this whole conversation, here's the cash. This is the point I would like to emphasize during my conversation. Just on few clicks, you can see one more interpretation of the slide, that the management of the balance sheet is called the governance, while the management of the just move back. So the management of the profit and loss is somehow called the management. So this is the reason now the new designation of the CEOs are called the head of profit and loss, and the new HODs has been named as the head of cost centers. So in normal very in the current scenario before the COVID, everyone is running behind the top line and the bottom lines. And there's a lot of pressure in the organization of the growth, how to increase the market share, how to bring more sales, how to increase more profits. And for that, we are basically, using we're not worried about the cash. And the cash normally comes under the conversation with the board. And when the board sits, and the boards are looking at the balance sheet and the assets and the the receivables, and that the cash at bank, and that the cash in hand and many other things. So what I feel in my practice by attending the different board meetings, the people are not giving the importance to the balance sheets as much as they have to give. And plus, the many executives even don't have understanding about, so that the discussion on the balance sheet is equally important as the discussion of the profit and loss. But profit and loss is more of days in days out operations. So this is the reason we are more engaged over here. And while the governance side, normally it's a quarterly meeting or in a monthly meeting or at the end of the year, the people start looking at, the cash situation is bad, and now we take a more loans from the bank, and make some cash and which in the company, and we start survival. And so by running behind the growth, every company is short of cash, not that concerned about the cash. The board of directors, shareholder, maybe they are concerned about the cash. So this is the criticality which basically pop this topic up in my mind, and I would like to put more lights on it in the coming slides. So let's forward. So in the next slide, so by looking at this thought process, so one thing is happening, which I am going to explain in the next slide, as it is disrupt the changes. We believe in top line. Is the belief in top line broke down? We believe in bottom lines. So the bottom line has gone, nothing is nowhere. We change our priorities, the change we operate, the change we review. Even in many companies, when I sat in the board meetings, it's profit and loss statement, because our reviewing eyes are more focused on the profits, and we act on all those elements which are eating our profits. So so the way we do the business. So I will show you some another dynamics that is basically on next slide. You can see before COVID-19, whenever I sit in any board meeting, this conversation way of this profit and loss, balance sheet, and cash flows, it's a 180-degree shift, guys. So now the conversation has moved another way down. The cash flow comes up, profit and loss, and then balance sheets. So it's not only in the normal discussion. It's it's the way we think. Is the business strategy need to be designed in this way? The shareholder meetings, shareholders, a lot of conversation with the boards are doing nowadays. It's all about bringing the cash priority at the number one. So I think thinking the cash before the profit, it will be the next disruption in the whole business mindset. It will challenge the growth. It will challenge the mindset of the investors to invest their cash to convert into more profit and more market share and more the growth rate. So this is the mindset which is being changed a lot. So move ahead to the next slide. So while I was working on this specific topic and while conversing with a number of board members around me, I feel that many executives in the organizations, they're really struggling about the concept of the liquidity of the company. And so I will put up a small insights and very brief basic concept how the basically to the liquidity analysis we can do, and how the executive should build these 4 capabilities within himself, along with the cost cutting, along with the cost analysis, along with the loss analysis, along with the market competitive analysis, along with how to increase the growth, and including how to do the pricings. This is very important, patron of the learning and top executives. They keeps on learning these things all the day. But the cash management, that's another skill set, that's another capability, that's another the inner belief and the passion to learn these. So I will show a very basic concept. So move to liquidity analysis. I put up a case in front of you just to build a concept. I think around people, but with the non-financial background people, they should to understand the liquidity situation of any business. Number 1 is the current ratio, number 2 is the quick ratio, and number 2 is the net working capital worth. And then we have a small summary of the liquidity analysis. So just move forward. I will go through these calculations. Let's take XYZ Corporation. I took a balance sheet of 2007 and 8. It's like all numbers are in $1 million. And if you can see in 2007, the current assets, where there are 3 things, are basically falling under the heading of current assets, which is the cash, account receivable, and inventory, and $84 million, $165 million, and $390 million, $642 million. In 2008, its sum is $708 million. While on the current liability side, the account payables and the notes payable, these are 2 things I have to pay. The total is $543 million. In 2008, it will reach to the $540 million. So this is a very, a basic concept of current assets and the current liabilities. Okay, so let's learn how to calculate the first ratio. So if you talk about the current ratio, so it's basically just divide the current assets divided by current liabilities. In the small table, you have seen that the current assets are 708 in 2008, $708 million, while the current liabilities is $540 million, and 1.311x is the current ratio. So this means that the firm can meet its current short-term debts obligation by 1.311 times over. In order to stay solvent, what is solvent basically? Solvent is another concept which the financial people knows by heart, but it's an organization which can pay their current debts from their own cash. So this is the solvent organization, like the chemical which can dissolve the rust, and this is similar concept. So the current debts may be act as a rust, and the organization is act as a chemical. So we are able to absorb our current debts. So its ratio, as per the financial guidelines, even the ideal guidelines, it should be 2. But okay, in the good scenarios, it should be 1x minimum, which means that we can meet our debts obligations. So the firm is solvent. You can see in 2007, it was 1.182x, while in 2008, it is 1.311x. It means that the organization performance has improved with respect to current ratio in last 2 years, in between these 2 years. And so this is the basically current ratio, but this is not giving you the right picture. This is that in the current ratio, the current assets, the inventory is sum up in the total, the current assets. So basically, there's another asset test. There's the next ratio will help us to understand that you just subtract the inventory from the current assets and see the real situation of the organization, because the current ratio will basically sum up the inventory as a capital, while inventory is not a cash, and you cannot pay your current debts or the liabilities by using that inventory. You need some time to sell that inventory, and then you can pay some cash. So this definition, you can see 0.529x, where the 708 subtract 422, and then it will be divided by our current liability is $540 million. So the quick ratio is 0.259x, which is less than 1. In order to stay solvent, we should sell our inventory. Even we could not pay the current debts without selling the inventory. This basically the number is telling me if it's 1, then I can pay my current debts from my current cash without selling my inventory. So this is the right number which can tell me how solvent am I. And I am more solvent if my current ratio is 1. So for all executives, we should have a very key close eye on this ratio all the time to keep our acid test, and it should be 1. So even if you start comparing these 2 years, in 2007 and 2008, even we have improved in 2008 because we 0.458x in 2007, while we are 0.259529x in 2008, we are improved, but not enough. So this is again a very, very hard learning for all the executives, that guys, we should know, understand, so we should keep our eyes on the asset, on our quick ratios, and our the current ratios. So move to the next slide. So that's another which is the important thing that we need to say, the net working capital, which is basically the current assets minus the current liabilities. Again, it's $168 million according to this small table. But by looking at this number, so my net payable is 540, while my net working capital is 168. So I'm in a very bad situation. So I could not, pay our current debts by using the current capital of the company. And so this number, at least should be equal to the current liabilities of my company. And it's better to see the things after subtracting the inventory from your balance sheets. Because if I have seen many companies where the balance sheets is 100, and out of that the 70 is inventory, and even that it's 80 is inventory. So if sudden pressure comes to pay my certain debts, and the short-term debts, which is you have to pay within 1 year, and short-term liabilities I have to pay within 12 months, I could not pay. And for that I have to run to the bank, and I take more money, and pay more markups. So this very basic knowledge that should be the learning skill, and the part of the the individual step-up cards, skill charts. So to learn these things from heart in order to be in the business. Okay, so let's see the summary of these 3 analysis. Into the current ratio is 2007. In 2008 we have improved our current ratio, we have improved our net working capital, and we have improved our quick ratio. But in the real sense, we have seen in the previous slides that with these numbers we are still unable to pay our current liabilities. And this is the situation which at this COVID scenario, I think so the 80% of our organization, they are facing these challenges, and they are unable to pay the salaries of the people even. And the payments of the vendor come second, and many other things, they are on the top of it. So this is a very hard and true learning which I would like to pass to my participants. And the liquidity, so just action that we need to do, everyone, every manager, every executive, just go guys, explore your balance sheets, do these analysis, calculate these ratios, and then make a very, very detailed brainstorming plan. How guys can you bring these ratios at the right numbers, where you cannot face a similar situation in future. So that's a learning we can do by learning this. It's a learning from these hard times, and we can apply these learning in future. So move forward. So just a few lights on another topics, and how basically we can work with the vendors and the different scenario making, which the Adil is basically working on that. We'll also present some scenarios to you while working on how can we play with the discounts with the customers, how can we play with the stretching the vendor payments, and how these by doing these, changing these attributes, how can it help me to manage my cash, and in how many days would so for how many days I have the oxygen in my cylinder, and from how many days of cover I have from the current cash I have in my company. And I have to create, a very short term, rolling forecast cycles to understand how my cash is playing the role. So this will be showed by Adil in our coming slides. Move forward. And this is very important thing that's also will be covered in the similar slides, that where to release the cash and where to hold. Just a few learnings from our side, that prepare a 3 months rolling cash flow. And we are making the selling rolling plans, we are making the buying rolling plans. So it's very critical to create the cash flow rolling plans. And also I would like to request top executive to see the cash flow situation on daily basis on this critical scenario, and preparing the 12 months way forward looking forecast scenarios, keeping in view the the collection associated with the latest sale projections. And you can make a number of projection and understand how much cash should I receive. And deferring all non-essential capitals, non-essential expenses at this time. And capex, we have to hold the capex for a certain span. And the necessary requirements, marketing spend we can freeze, and we can move toward the social media and digital media. And then further cost saving opportunities and even cash saving opportunities we can bring on the table. And negotiation with the vendors, that's another part that we need to bring with. And one question I would like to add the answer, one question which has been asked to Mr. Mahbub in the last slides. The customers and the vendors are not technological savvy. They don't know how to use the technology, and how can we bring them on board. Guys, this is the ideal time. We need to work from the heart to work with our customers and the suppliers to teach them about technology. So otherwise we are not at one table, we are not at one page. So this is very critical time. And before the COVID, one person said that I'm okay, I have a SAP, I have a Microsoft Dynamics. If my supplier don't have these tools, it doesn't meet me, it doesn't matter. I can push things hard, but I can do musclings. But from this scenario, it's very important to teach people, to teach your suppliers, to teach your customer even about technology. And maybe this will be the next additive at a competitive advantage, as well as the additive services, other additional services you can offer to your customers. And if you buy from us, so we can offer the following courses to you. If you buy from us, if we will buy from you, we can build the following capabilities in your organization. So you can plug such things along with the money relationship with your customers and suppliers to open a new horizon of the world and the new new era which is being started today, and after this this epidemic situation. And how to perform the sensitivity analysis upon the cash outflows, it will be again given by Mr. Adil. He will basically display a few simulation in front of you and build some scenario based decision making. So let's summarize my session is that using the crisis to drive the urgency on the cost discipline, securing the access to the credit to preserve the liquidity, and integrating the worst case scenarios into the financial plans, and reducing employees cost by use them more productive and make them the last resort in order to control your cost. And this is all from my side, and best of luck. And guys, thank you very much. Any question, I'm open to answer.
Thank you,
Yes,
Mr. Abdul Rehman, for your session again. So we are just waiting for the questions. So we do not have any questions yet. And if any of the attendees wants to ask question directly, so you can please raise your hand so that I can provide access to speak directly to Mr. Abdul. Mr. Abdul will just wait for 15 seconds. Okay, we have one question here. Definitely for the people who wants to share our presentation, so we can probably discuss with that and we can share it to your email ID maybe after the webinar.
Yes, no problem.
All right. So I hope there is no questions. So if anyone doesn't have, we can skip to, we can proceed with our next speaker.
Mr. Adil, and maybe he will present one simulation and then we'll move forward.
Definitely. All right.
Yes.
Thank you. Thank you.
I'm sorry, Mr. Abdul. We have one more question which is being raised right now. How to balance and define right cash amount?
Okay, good question. Basically, you have to understand in this current scenario what are the minimum cash flow out from your company, and you just divide it into the next 30 days. You just estimate what's the most critical payments you have to do in next 60 days, and you calculate the per day cash out, and then divide it. It will help you to understand the cash days of cover. It will help you to understand how much cash days of cover. It's primarily you can calculate it by creating the scenarios. If the market will open at May 30, then this will be my cash scenario. If the market will open on 15th May, then it will be my cash scenario. Maybe you create 3, 4, 5, 6 scenarios, and then you can build on the days of cover of the cash, and or so that you can take the prior help from someone to arrange your cash within your company, or you can write to your suppliers or someone else to at least hold or extend the lead times, which is explained by Mr. Adil during this simulation. Hope it answered the question.
All right. So we have one more question also by Afiz Ali. So salaries or essential component. What else do you think important to a cash flow?
So the vendor payments is very important because the vendors are really relying on you. They have to pay to their people. Their vendors' people's salary depends upon your payments. So I think so. The one thing is the interest of the bank. So I can talk to the bank and have a better negotiation, and I can basically reschedule my payments to the banks because banks have cash. Banks, it's the first priority. I should talk and go to the banks that please give me some room so I can at least pay cash to my employees and the vendors. I think so. With the employees, the second thing is the vendor, and the third is very critical thing is definitely the shareholders, and they have their certain lifestyle. They need some sort of cash to meet their regular expenses, and I think so. We also think about that stakeholder too, but we can request them to just minimize their living style for the few days and few weeks, so at least we can go through this difficult situation, and then things can be normalized. Hope it's answered the question.
All right. Yes. Thank you so much. More question also. So as a thumb rule, shareholders should reduce their part. How much?
I think the expectation from the shareholders, I am telling you, in this current situation, the pain in the heart is the most, the concerned part is the shareholders, and I think so. They can reduce their cost by 50% even. They can basically what the shareholders are expecting. In case of private limited companies, there are certain drawings that being expected are built in the balance sheets for the future drawings, and they can make they can delay their drawings for the few more months. They just take their expenses, the current expenses they can take, and the drawings maybe they can leave that drawings to the next coming months. But there's no specific formula. And at this current situation, I think so every shareholder is empathetic with their companies, with their employees, because at the end, the biggest stakes of the shareholders are there in the market. Imagine they put up their whole lives to build the empires. So the empires are, stopping in front of them. So they are very, deeply concerned about these things. Thank you.
All right. Thank you so much. I have one more question here. So this is for all those speakers. So should we start up a new business related to service industry? If yes, then in which quarter of the year should the establishment taken place? Looks like establishing a new business sounds weird. So when is the right time to establish a new business?
I would like to answer this question. Number one, the business starts when you are in the problem. The most excellent ideas comes to solve the problem of the society. any business which is connected to solve the problem with by your product or by the services is the right business. And in this epidemic situation, and there are a lot of problems which people observe which they never observed in the past, or I would like to request, maybe hope for not seeing in future. But this is the more problem we are facing. Our brains are thinking more deeply to extract the more ideas. I think so. This in this free times, we should work, create more feasibilities, think about out of the box ideas, and build the business feasibilities around that. Even if I talk about MNBC, I think so. We are creating feasibility every third day of the week, because we feel that the thousands of opportunities that are oscillating around you because of the situation that our brains will never think about before the situation. So what he was talking about, when to open the concern, I think so this is the time to open the concern. Yesterday you have to open the concern. So this is not about not adding the cash in the new business, but at least you can build up the idea, you can build up the structure. Even the current employees you have, you can engage those employees into that discussion, conversation, ideas. This is the way you can engage people more strongly, and you can engage yourself more strongly.
All right, thank you so much, Mr. Abdul, on this. And if Mr. Usman want to add any points on this, so can you please do it so that we can move to the question?
I agree to what Abdul Rehman has said. Primarily, the focus and the right answer to this question would be understanding more in depth with the what kind of service that the gentleman is planning to initiate. If it is something related with the non-essential categories that we have talked about earlier, there is a fair decline in demand for quarters to come. But this is the right time. If you are already an organization and you want to allocate your resources to the new venture, then this is the right time to open. But if you're venturing into as a new business, then we suggest for a non-essential category, let this period breathe for another quarter, and then have a right feasibility with multiple scenarios, as Mr. Abdul Rehman explained. The best case possible case, so that we understand the cash flow, the capital investment, and other working capital investments accordingly.
I'm sorry to interrupt you. There is a lot of echo at the background.
I think people need to mute. Was I audible at that time?
I think there is a 2-page which you have opened, maybe. So that's the reason.
So Boila, can I add one thing over here?
Sure, definitely.
So, nowadays it's very critical to connect all the shareholders, stakeholders, business partners. They need to spend some time together by adding some, intellect people within their group, and extract list down the ideas for the new businesses. And, onboard your finance manager, create the number of feasibilities to in the different cases, either in the services business, either in the product businesses. But I think so this is the time where managers should think about, and all the executive need to think about, how to create more channels of revenue if such things will happen again. This is very critical time, and we can help, I think so, many people if they want, and they can connect us after the call, and a lot of things can be initiated after. No issue.
All right, thank you so much, Mr. Abdul and Mr. Usman. So we have one last question. So can we proceed with that, or with the next speaker? Could you please advise me on that?
We can
go for the
answer that
question.
question. Okay.
All right. So this question is especially to Mr. Abdul Rehman. So probably Mr. Usman also can add on this. So how can we improve our liquidity where the whole sales and supply chain is on credit, and our customers are asking increased credit terms along with fear of cancellation of orders?
This will be discussed in the simulation, which is shown by the Adil. Basically, we connect, we create two scenarios. One is the cash is coming from the cash customers, and second is the cash is coming from the credit customer. So if the customer will pay me, the credit customer pay me the cash today, so I will give him discounts. I will give him maybe further discounts in the future. So that will be shown by Mr. Adil in his simulation in the next few minutes.
All right. Thank you so much, Mr. Abdul and Mr. Usman as well for answering all this question. So
Thank
we
you.
will move to the very last but not the least speaker named Ali, and he's going to speak about the topic strategic supply chain architect, and his expertise in all in productive enterprises and his industry verticals are
Biola,
entertainment.
may I suggest if you want to allow Adil for now?
I'm sorry?
Adil will be presenting the simulation and then we'll move on to Mr. John
All
Dick.
right.
John.
Definitely. I'm sorry about that.
All right. So for a quick overview of this simulation that we have here for the cash flows, we have this simple cash flow equation right here in the normal scenarios. Let's say what initial balance do we have at hand, and what sales are we expecting as our general revenue in our regular revenue, and what customer collections or what inflows or the account receivable that we are expecting from the customers, and what other source of incomes, if there may be any, what other incomes we may be expecting in a normal scenario. So these would be the total inflows, and as Abdul Rehman has discussed, with the current COVID situation, there might be a certain probability that we might not be able to make that same stream of inflow that we used to make. So we need to make a very realistic guess of what the actual income flow or the current inflow of cash is going to be in the current situation. So let's say we have these opening cash at hand, and then we have this what the revenue is going to be in terms of sales, and then what account receivable that we're going to clear in the coming month. And we have to be very realistic. Let's say in the normal scenarios, if we have an average inflow of 10 million rupees or $10 million every month, or for the selected period of time, what is going to be the new receive amount that we're going to be receiving from our customers as in terms of account receivable with the current situation at hand. So we need to take into account that what's the expected cash flow is going to be, and what's the total cash flow is going to be in terms of inflow. So these are the scenarios right here, and let's say if we want to increase these inflows, we have to give some sort of discount, or we have to give some sort of promo to the customer. Let's say in case where we want to increase our sales revenues, we would want to we would want to offer some sort of promo to the customer. So let's say if we are into a distribution business and we want to do X amount of revenue generation this month, we have to give some sort of trade benefit to our customers as well. And let's say if we have some account receivable pending at our customer ends, and since we know now that the situation at hand, most of the customers won't be very willing to give us or to pay what they're due to pay us. So in order to increase that, or in order to generate more cash inflows, we might be offering some discounts to our customers who already owe us some money. So let's say if we want to create a situation that in case a customer is going to pay me up to 20%, or let's say 3% of my inflows or what they were supposed to pay, I'm going to give them a certain percentage of discount. So let's say if a customer pays me 5 million rupees or $5 million in terms of what they had to pay me for this period of time, I'm offering 3% of discount if they pay me up to 20% of their total payable. So let's say, and if they're paying me 5 million rupees, I'll be giving them a discount of $150,000. Let's say, if they're offering me $5 million, I'll be offering them a 3% discount. And same it goes in the case for sales revenue. And this is going to give me a simulation where I can actually see my forecasted cash inflows if I do a promo or offer a discount to my customers. Same goes for the outflows as well. So if I'm going to, I had some cash outflows planned in the current period, what what part of my outflows I can reduce, or where can I get a discount from these vendor payments or from miscellaneous expenses. I need to figure out if I need to do any capital expenditure in the current month or not. So I need to define what my necessary payments are, what are my necessary expenses are, and which one are the unnecessary, which I can't defer or just lay off for the time being. So this is the set of all the inflows and the outflows, and what this eventually gives me, this is actually offering me that what my total opening balance was, what's the total inflows, and what's the total outflows, and what is going to be the total cash situation when my current period ends. Let's say what would be the ending balance at the end of the month, let's say, and how I need to prepare for the next month. So this simulation can be done for a set of months that I want to plan my cash flows on, and I need to plan my cash flow activities accordingly in order to manage my cash flows in a better way. So that's it from my side, and now I'll be handing over to Viola for the next speaker.